Welcome to the Thought Leadership Series featuring interviews with some of the best minds in the industry. Today's special guest is popular platform speaker and best-selling author, Tom Hegna. I'm Steve Savant, syndicated financial columnist and talk show host. In this segment, we're talking about life insurance in a low interest rate environment and how this can cause the greatest underinsured market in the country's history, all from Tom's book, Paychecks and Playchecks. Well, Tom, we're talking about a low interest rate environment, and I got to tell you, since 1990, it's been dropping like a lead balloon. And and even though we keep hearing rumors that Yellen's going to up the rate, I bet it's going to be very slow and incremental. And this is impacting, I thought, well, it's just impacting annuities and bonds. It's impacting life insurance, which I never thought about.
Yeah, and here's the risk. See, in a 1% interest rate environment, you know how much life insurance you need to protect $50,000 of income? You need $5 million. Now think about that. We're in a 1% interest rate environment. How many people do you know that make $50,000 a year have $5 million worth of life insurance? And you say, well, Tom, that's ridiculous. Okay, even if we were in a 5%, and we're not, but even if we were in a 5% interest rate, it would take $1 million to protect $50,000 of income. So what I'm telling advisors is you need to be recommending, at a minimum, $1 million of life insurance for every $50,000 of income. Now, if people think that's too much, I'm going to tell you a true story, and this happened right here in Arizona. It happened a few years ago. I got a call from my oldest son, Ryan. He said, Dad, I need a favor. My best friend's brother died 3 weeks ago, and his wife, the widow, just got a check, and it's a big check, and she wants to meet with you on Saturday. I said, well, Ryan, what does she want to meet with me for? I don't sell anymore. I'm a speaker, author, full-time. I don't do any more personal production. And he said, well, that's why she wants to meet with you, because she knows you know this stuff, and you're not going to try to sell her anything. And I said, well, Ryan, I've been gone for 13 days. I'm leaving for 6 days. I'm home for 1 day. I can't drive around the valley looking for, to talk to somebody. But I said, if they want to come to my house, I'll meet with them. Well, guess what? The widow, the dad, and the brother showed up at my house, 9 a.m. Saturday morning, sat around my dining room table. She was 42 years of age, 2 little kids, husband killed unexpectedly, a $1 million death claim. After my condolences, she said this to me. She said, Tom, I never thought I'd be a millionaire. Now, here's what I want to do. I want to build a custom house on a lake with a place for my daughters to play. I don't want a cookie cutter house. My husband did not like cookie cutter. I want a custom house on a lake. I had to stop her mid-sentence and say, ma'am, time out. We're not going to be talking about any custom houses. You only have $1 million. In a 1% interest rate environment, that's $10,000 a year. I'm here to see how you and your daughters can possibly survive on $10,000 a year. Now, maybe you could get $20,000, maybe $30,000, $35,000, $38,000, but every expert I know says you can't take out 4%. So max, she's looking at $38,000 a year of income. There's no custom houses at $38,000 a year of income, and she was shocked. She said, my husband made $250,000 a year. How can we survive on $38,000? See, here's a woman who thought she was a millionaire, thought $1 million is a lot of money. In this low interest rate environment, it's nothing. And so what I'm telling you is people all over the country are so far underinsured for life insurance, they have no idea.
Now, the price of insurance has come down so much. I mean, we're talking about living longer. The premium cost gets smaller.
Right.
So even though $1 million sounds like a lot to most consumers, the price tag for this, especially 30s and 40s and decent health, is really not that much.
No, it's inexpensive. And you compare about what the risk is if they die without it. Their family will be devastated. And so carry at least, and for the advisors listening, make sure your own situation is straight. Make sure you've got at least $1 million of life insurance for every $50,000 of income. That's just a great rule of thumb. See, on the day you die, your spouse is going to ask 4 simple questions. And it's not going to be, do we have term life or variable life or whole life or index life? It's going to be, how much life insurance do we have? How long will the dollars last? Can we stay in our same house? And can the kids go to the same school? That's the 4 questions your spouse is going to ask. My question to the advisors is, what do you want the answers to be? You know, people are just underinsured today.
Well, when you think about it, we're trying to protect a thing you call human value. I mean, this is not only your debts and obligations. I think everybody understands that, but you're actually bringing a new number to the equation by saying, how long, she said, I made $250,000. She's comparing that to your 38 grand. It's not going to work.
Right.
So I'm replacing not only maybe obligations and debt, but I'm looking at what's the value my husband brought to the table while he was alive.
Income for the rest of your life, potential at least till retirement. Now, one of the objections you get a lot of times, people say, well, I want term insurance. You know, there's a couple talking heads that say only buy term insurance. When that comes up, here's the exact words I say. If somebody says they want term insurance, here's the exact words I say. Let me tell you the ultimate truth about life insurance. Here's the ultimate truth. The only policy that matters is the one that's in force on the day you die. Let me say that again. The ultimate truth of life insurance is that the only policy that matters is the one that's in force on the day that you die. Less than 2% of term policies are ever in force on the day you die. Now, that doesn't mean term is bad, but what it means is term should never be your only policy. Term is a supplemental policy. It's an extra policy. It's a policy when the kids are young, when your income is low, when your needs are high, but you've got to have permanent life insurance because 98% plus of the time that you have term insurance, it'll expire before you do. And you'll die without any life insurance. And so term insurance is there for supplemental extra. It's not there to be your only policy.
Well, for more information on the impact of low interest rates and how life insurance can actually help you expand your practice, just click on the landing page address in the video description. We'll be right back with more from Tom Hagner.
A solid web presence has never been more important to the success of your business. Introducing Agent Website Creator, provided by CreativeOne. Through Agent Website Creator, you can create your own personalized website and have it up and running easily with zero knowledge of programming. Choose from several designs with easy drag and drop customization. Get proven lead generation offers, professionally written articles, and helpful financial calculators. Plus, the ability to embed videos, integrate your social media, and more. Update your website anytime and show the world within minutes. The best part? It's hosted for free. To learn more about Agent Website Creator, call your CreativeOne sales team at 800-992-2642 or visit us online at creativeone.com.
In this segment, we're going to talk about life insurance in a low interest rate environment and retirement planning like charitable giving, legacy planning for children and grandchildren, or even final expense. It's all from Tom's book, Paychecks and Playchecks. Well, Tom, let's talk about this. I mean, when I think about it, I always think about life insurance as just an indemnification issue, but there's a lot of ways this can be used, and even in retirement planning, which shocked me.
Yeah, see, a lot of people think life insurance has nothing to do with retirement. I argue life insurance has everything to do with retirement. See, it's the life insurance you bring in retirement that allows you to spend your money. One of the reasons people live this just-in-case retirement, they never fully enjoy their retirement, is because in the back of their minds, they keep thinking, I got to leave Johnny and Susie some money. And so they deny themselves a retirement because they want to leave their kids some money. So what we did with our own retirement plan, one of the first things we did, we said, how much money do we want to leave to our kids? We want to leave them something, don't want to leave them too much. What that number was, we then bought for pennies on the dollar life insurance to go to the kids. Guess what that frees us up to do with all the rest of our money? Spend it. Now, some people don't like their kids anymore, so I always talk to them about their grandchildren because I know they love their grandchildren.
Okay.
So here's Annie. She's 62 years of age. She has $100,000 in a CD. She says, Tom, this is my just-in-case money. I don't need it, but I named my 6 grandchildren as beneficiaries. And when I die, they're each going to get $16,950. Now, that's a nice grandma. But my question is, if it's her just-in-case money, has she done the right thing and maximized it for the grandchildren? And really not. See, if she took that $100,000, put in a life insurance policy, she could still access it if she needed it in an emergency. In fact, there are now some policies for seniors that have 100% money-back guarantee. So you put it in. If for some reason you don't want it, you get it all back. But now each of the grandchildren would get $36,000 instead of $16,000. So see, don't leave your grandchildren any money either. Leave them life insurance because you can leave them so much more for so much less.
Now, this leverage idea, a lot of people have a real heart for their children, for their grandchildren. What about charities? Because they have a lot of heart for nonprofits.
Absolutely. So let's talk about charitable giving. So here's Al and Helen. They're very charitably minded. They saved up $50,000 they want to give to charity. But when they start talking about it, they each want to give $50,000. Well, how do you each give $50,000 if all you get is $50,000? You put it in a life insurance policy. It immediately creates $100,000, a gifting power to give to the charity.
Now, to me, this is powerful because a lot of people have a big heart, but they have a small wallet.
Right.
And the leverage of life insurance can really provide their their benevolency to whatever nonprofit they like. Now, when we're talking about this, I just want to mention this just because some of our registered investment advisors and our RIAs watching may not be conditioned to this idea of, should I be doing 2 individual policies, or should I be putting 2 people on one policy called Second to Die or survivorship?
Yeah, and again, I kind of leave that up to the advisor. I mean, for my wife and I, we bought a Second to Die because we wanted to go to the kids after we're both gone. All right, I've got policies that will go to her when I die. She's got a policy that will go to me when she dies. But then when we both die, that goes to the kids. You get the most amount of leverage with that. Okay.
Now, final expense, usually people, by the time they think about final expense, they're already in their 60s, and they already have issues with health. So they have to buy some kind of guaranteed or simplified issue off the television just to kind of, but talk about that and covering final expenses.
So let's talk about that. Here's a 70-year-old couple, John and Leslie. Now, they didn't do as well financially during their lifetime, time. They kind of struggled, but they saved up $15,000 each or $10,000 each for their final expenses. But the problem is $10,000 won't cover their final expenses anymore, but they don't have any other money. Well, did you know even at age 70, they can buy life insurance and that $10,000 each can turn into $30,000 of final expense. So they just took the $10,000 each they saved, and they did get leverage. They didn't get as much leverage as you or I would get because they're in their 70s. But still, they turned their $20,000 into $30,000, and for them, it was a solution. It was enough.
Well, I think this is really something to keep reminding people. It's not only the leverage, the number you get from life insurance, but there's some tax advantages to this as well.
Absolutely. This goes tax-free to the kids as well. So, and then the last idea is protecting Social Security benefits. You know, here in this case, the husband's getting $2,100 a month. The wife gets $1,100 a month. What happens when he dies? Well, she gets his. What happens to hers? It's gone. Well, can she live on just one Social Security check? And if not, that's where life insurance can come in. And Steve, there are some companies now that issue a first to die. We just talked about second to die. First to die, you insure both the husband and wife. Whoever dies first, it pays a death claim. So that's perfect for a scenario like this because you can insure both the husband and wife. Whoever dies first, there's money to replace the other one's Social Security.
I think this is a really important strategy because, Tom, a lot of times when the first spouse dies, not only do they lose the Social Security, but they're pushed into another tax bracket.
Yes.
So looking at life insurance as a Social Security supplement because of that first death scenario, I think is really still relatively new for most of our advisors, even our insurance professionals.
Yeah. And so I think life insurance has many uses in retirement. You can get tax-free income from it. We didn't even go there. So there are many other uses, but that's in the book, Paychecks and Playchecks.
For more information on using life insurance in retirement and how it can help you build out your business, just click on the landing page address in the video description. And for more information about our shows, seminars, and workshops, just follow us on social media or visit our website. I'm Steve Savant. We'll see you next time on the Thought Leadership Series, and remember, keep thinking outside the box.